Assalamu alaikum again. So this is the second part of the chapter. In this part, we are going to continue with the other remaining items other than the current liabilities. I hope by now you have understood what are current liabilities. What I suggest before you start this part of the chapter is please watch the video by keeping your textbook open. Okay, especially that learning objective 1 because it's a huge part of this chapter. There are different examples. Have a look at each of the illustrations which is given in the textbook and let me know if you have any questions. Right, so for this part of the chapter, we'll talk about provisions. Now, what are provisions? We also call them as contingent liability. Now, sometimes you may have certain items which you can neither report it as a current or a non-current liability. You know that it is due, but then you do not know exactly when it is due, or sometimes you may not even know what is the amount that is due. In that case, you may call them as contingent liability and treat them as provisions. Types. The first one is called the maybe some obligation which is related to litigation. Litigation is maybe the legal cases that is pending against you. This could be very common in businesses that one company may file a litigation on another company for various reasons. So you, at the point when you want to prepare your financial statement, you may not be sure of when you may want to make a payment or how much. So this could be one type of provision. The second could be warranty or product guarantees. Companies give guarantees to customers on the products or the services that they offer. In that case, when you give a warranty, you are actually promising your customer that if something goes wrong with your product or service, you can definitely come back to us and we are going to either repay, repair, or maybe do the needful to make things right for them. But now, at the time when you are actually preparing a financial statement, you may not know exactly how many customers are going to come back or what you may have to pay in order to meet those warranties and guarantees. Next, maybe you are restructuring your businesses. Maybe you're making some changes to your business structure, or maybe you're making you're reconsidering things. In that case, also you may not know how much you may have to pay or receive from the restructuring efforts. Next comes some environmental damages. Now, this is sometimes for some companies it may become a very serious matter that they may have to pay huge amount of money to uh, adjust or maybe to set right the environmental damage that they have done. This could be a legal requirement or sometimes just a gesture that the company shows that they have made amendments to the environmental damages that they have done. Okay, so this we'll consider this one as we go. So we'll start with the looking at what are provisions. Company accrue an expense and related liability for a provision only if these three conditions are met. Now, what are those three conditions? First one is that the company already has an obligation because of the past event. For example, if it was a constructive provision or a legal provision, basically it is because of something that you have done in the past. Maybe, for example, maybe let's say a company like Apple, maybe it has introduced a new model of the product, but then maybe another company like Samsung has filed a suit against it. So now this obligation is because of this new model that was brought in this year. So that means this provision also should be created for this year as a result of the past event. It could be probable that an outflow of resources will be required to settle this obligation. The second condition that should be fulfilled to create a provision is that the possibility that you will have to uh, spend some resources. It could be cash or it could be any other resources, but then there is a possibility that you may have to pay. Thirdly, is that you can make a proper estimation. Now, when you do not know how much exactly you can pay or what is the estimated amount, then there is no way you can create a provision in your financial statement. So, the third condition for you to create a provision or recognize a provision is that there should be a reliable estimation. Right? So, let's understand this with examples. So, let's look at this example for warranty. Let's say Santos gives warranties to its customer related to the sale of its electrical products. These warranties are for 3 years from the date of sale. So, based on the past experience, it is probable, that is more likely, that there will be some claims. So, now you should note here that there is a probability that the company may have to pay because of their past experience. So, what do you think? Do you need to recognize this in the financial statement or not? So remember, there are three things that are required. One is that you know that it's you can actually see the probability that yes, it is possible. So in that case, yes, you need to recognize. So here, but there are two conditions which they need to fulfill. First one, there is a warranty which is an obligation for the company because of the past obligation. What was the past obligating event? That they have made a sale, wasn't it? So then yes, it is actually giving rise to some legal obligation. So this is the next thing. And this warranty is may result in the outflow of resources. That means because of this warranty, you may have to make some payment, and there is a probability that this can happen because of their past experience. The company knows that always they had to make a payment on their warranty promises. So yes, the company has to recognize this warranty. Are supposed to estimate how much is going to be the loss and then create a provision for such warranty liabilities. Okay, so let's take another example for constructive obligation. Now, what is a constructive obligation? A constructive obligation is that you have a past practice, okay, or maybe you have some policy which is well known and people know about it. People are expecting you to behave in a certain manner. Maybe you have not made a very specific promise, you have not given a warranty, you didn't say that it's going to be 3 years or 5 years, but because of your past behavior, people expect you to behave in a certain manner. Okay, so that is called as constructive obligation, because of which the company has created an expectation, a valid expectation on the part of other parties who believe that the company is going to do something to meet those responsibilities. Okay, so this is called as a constructive obligation. That means that you have not given a verbal or a mm, factual what you say guarantee or warranty, but just because of your behavior, but just because of the policy of your company, people have rightly expected that if something goes wrong, you're going to take action. So in that case, yes, you need to be aware. Okay, so let's look at this one. Christian Doyer has a policy of refunding purchases to a dissatisfied customer, even though it is not having any legal obligation to do so. So now should they create a provision for such refunds? Okay, but now one thing to note here, this policy of making refund is quite well known. That means people know about their policy of refund. So in that case, yes, the company has already created such a what is such a scenario that people are expecting the company to refund if the customer is dissatisfied. So in that case, yes, the company has to recognize such a provision for refund, because it is assumed that a reliable estimate of the amount of the obligation can be determined. Then they have to meet the obligation by creating a provision. Right, let's look at another example of a lawsuit. Assume that an employee has filed a case for £1 million on November 30, 2019 against this company, Morrison Supermarket, for the damage that it suffered when the employee slipped and suffered a serious injury at one of their facilities. Morrison's lawyer believed that Morrison will not lose this lawsuit, putting the probability of future payment is less than 50%. Now, what does that mean? It means that the chances that the company will have to pay is less than 50%. So the probability is very less. What do you think? Should the company make a payment? Now, again, one thing we also need to consider is that it is possible 50% or maybe less than 50% that they have to pay. So then, because the probability is very less, that is not very probable, in that case the company need not recognize such a liability. Maybe they can disclose it, however there is no need to actually create a provision for this. Okay, so how does the company determine what they should report for a provision? In other words, here we're talking about how do you measure the provision. If you can think about those examples that we just looked at in the previous slide, you will notice that if maybe an employee has claimed £1 million for damages, but what is the guarantee that if the company loses the case, that the court is actually going to say $1 million or euros or pounds, or maybe less than that or more than that? So we are not very sure of the amount, especially in any of these cases of provisions. Even if I take the example of warranties, maybe we say there is a warranty, but how many customers are actually going to come back? We do not actually know, right? So IFRS says that the amount recognized should be the best estimate of the expenditure that is required. Now, when we say best estimate, what does best estimate mean? So best estimate represents, excuse me, the amount that a company would pay to settle the obligation as they believe at the date of the current financial position. Okay, so when we say best estimate, as of today, how much do they think they are supposed to make the payment for? That would be the best estimate. Okay, let's take some example to understand the best estimate or the measurement of provisions. Let's say when they are going to make the best estimate, the management has to use their judgment either based on the past or similar transactions, maybe discussion with the experts, or any other information that is available. So let's take this example of Toyota. So let's say Toyota might determine that 80% of its car will not have any warranty cost. 12% may have some subsidy and 8% will have a very small cost. By this, they may put weightages on all possible outcomes and maybe finally they arrive at an expected value for their warranty liability. Hope you got the point. Okay, let's take another example. Let's say Carrefour. Remember, Carrefour is a company which is doing retail businesses. In that, they sell so many items. So it may not be possible to actually calculate the amount they have to refund to the customer for maybe spoiled products individually. So what they could do is they may refund to the customers for the product sold, may be viewed as a continuous range of refunds, with each point in the range having the same probability of occurrence. In this case, a midpoint in the range can be used as a basis. So they could do a mathematical calculation and say that on an average, we may have to pay the customer so and so amount. So that amount will be used as a provision. Or maybe another example for a pharmaceutical company, let's say Novartis lawsuit. A big company, especially a pharmaceutical company like Novartis, may be involved in so many litigations. Sometimes the issues can be related to their products or whatever. Sometimes a single obligation can be a huge amount, or sometimes each individual lawsuit can be having different outcomes. So the most likely outcome of the lawsuit can be considered to be the best estimate. Okay, so one more thing to note here, whenever the company is measuring the provisions or the contingent liability, they must consider the time value of money, that is, they use the present value of the future payments for today. And future events that can have an impact must also be considered when they calculate the amount that is to be added to the provision. Fine. So with that, let's go to a little bit advanced on provisions, some examples on provisions. So provisions, as we already saw, can be of these types: lawsuits, warranties, consideration payable, environmental provisions or onerous contracts, or maybe even restructuring. Let's go on them one by one. Okay, but let's have a look what IFRS says. IFRS says IFRS actually requires extensive disclosure related to provisions in the notes to the financial statement. Now, when we say provision, note that only when the three conditions of provisions are solved, then only you can measure the provision and put it in your balance sheet. However, if the provisions are not measurable, even then IFRS says that you have to mention them in the notes to the financial statement. If the company do not record or report it on the notes to general risk and contingencies. Sorry, what this means is that it's not required that the company has to mention each and every risk that they are facing. No, it's not actually a requirement. They don't need to talk about the general risks and contingencies which is inherent in their businesses. For example, they don't have to mention the possibility of war, maybe strike, uninsurable catastrophes, or even they don't need to mention all these general risks. But any specific risks may be related to these six items like lawsuits, warranties, or any of these has to be mentioned in the notes if it is not measured and put in the financial statements. So with that, let's go one by one. Let's talk about the litigation or the legal provision. Sometimes the company may be required to make a payment in the future which is arising because of some liability due to some litigation or maybe claims and possible assessments. So in that case, period in which the underlying cause of action has taken place must be considered. The probability of the possibility or the percentage of probability of unfavorable outcome, and also whether you can actually estimate the amount need to be considered. If you can notice, these are the three very same conditions that we talked about in our previous slide when we said the three conditions required for recognizing or measuring the provisions. So the same three, the time period should be in the past. It should have already actually happened. There should be a probability, huge probability that it could be unfavorable outcome. And thirdly, you should be able to make a reasonable estimate of this amount. If these three conditions are fulfilled, then yes, you have to recognize the legal provisions, sorry, litigation provision, and put it in your balance sheet. With respect to unfiled suits, unasserted claims, or assessments. So sometimes maybe you know that the other company is going to file a suit, or maybe somebody else or the third party is going to file a suit, but then it has not yet been filed, or the claims has not yet been asserted. In that case, the company must determine the probability that such a claim can be asserted, probability of the unfavorable action. If both of them are possible, then yes, the company has to consider this on the date of the financial statement and record it accordingly. Let's take this example. Let's say Onerous is involved in a lawsuit on 31st of December 2019. So you will pass entry on two conditions. First condition A, prepare December 31 entry assuming that it is probable that the company may be liable to pay some 900 some currency as a result of this suit. So can you see the amount has happened because of some lawsuit which is already in case. Secondly, there is a possibility, they are saying there is a possibility, and the amount is also estimable. So it means we have to pass an entry for this. Okay. Secondly, B, on December 31, prepare an entry, if any, if it is not probable. So now this is something which you need to consider, that the possibility that the company will have to pay is not possible. In that understood, we don't need to pass any entry. So what is the entry you would pass on December 31 if it is probable and you also know the amount? In that case, the entry you pass is the lawsuit losses 900,000 whatever, and lawsuit liability 900,000. And for B, you don't need to pass any entry because it's not probable as on that date, right? So with that, let's go to the second item, provision due to the warranty. Warranty is the promise that the company makes to its customers that if anything goes wrong, they are going to make the payment. So promise made by the seller to a buyer to make good on a deficiency of quantity, quality, or performance in a product. If it is probable that the customer will make the warranty claim and a company can reasonably estimate the cost involved, the company has to record it as an expense. So company often provide two types of warranty. One is called an assurance type of warranty, and the second one would be the contingency type of warranty. So what is assurance type warranty? It's a quality guarantee that the goods and the service is free from defects at a point of sale. So this obligation should be expensed in the period of the goods is provided and it is performed. That means at the point of sale, when the sale happens, immediately also the warranty must be recorded and the warranty liability must also be taken into consideration. With that, let's look at this example. Let's say Denson Machinery Company begins production of a new machine on July 2019 and sells 100 of these machines for $5,000 cash by the end of the year. Each machine is under a warranty for 1 year. Denson estimates, based on the past experience with similar machines, that the warranty cost will average $200 per unit. Further, as a result of the parts replacement of the services performed in compliance with the machine warranty, it actually incurs $4,000 in warranty cost in 2019 and $16,000 in 2020. Okay, so each machine, the company has given a warranty for 1 year, and it's possible that they may incur such a loss on the warranty expenses. So what is the journal entry that the company has to pass for 2019 and 2020? So let's start with the 2019. Here we could say first thing is when the sale took place in 2019. So as the sale is being recognized, so also the warranty liability. So the entry would be 500,000 cash that was received when the sale was made. Out of that, sales revenue is 500,000, and on the at the end of the year, when you want to pass an adjusting entry for the warranty liability, you would be passing an entry for the warranty liability from July to December. So the warranty expenses 4,000 and the cash that you actually paid 4,000. And at the end of 2019, you should also pass an entry for the expected warranty liability for 2020. In that case, the warranty expenses 16,000 and warranty liability 16,000. So if you will understand this when you prepare your financial statement, that is when you prepare your balance sheet, you will see that the current liability will be 16,000. How would you get that? That would be 20,000, that is the original liability, minus 4,000 which was already paid. So you have a 16,000 warranty liability on your account, and of course your warranty expense totals 20,000, 16,000 from this entry and 4,000 from the previous entry. Right, so to record the payment of warranty liability, which was actually incurred in the next year from January to December 2030, so warranty liability 16,000 and you actually paid a cash of 16,000. So at the end of 2020, there is no more warranty liability for this part of the machine which is sold in 2019. Again, remember the warranty was for 1 year, so by the end of 1 year, the warranty liability also gets cleared in this way. So we say that company provides two type of warranty. One is the assurance type warranty and the second one is service type warranty. Now service type warranty is actually you will be giving additional service to the customer if some fault has occurred in the future. So usually it is recorded as an unearned warranty revenue account, and recognized revenue is spread over various years using a straight line basis. So fine, let's look at this one. Let's say you purchased an automobile from Hamlin Auto for 30,000 euros on January 2, 2019. Hamlin estimates the assurance type warranty cost in the automobile for 700 euros, and Hamlin is going to pay for the repairs for the first 36,000 miles or 3 years, whichever comes first. Normally, this is the way the company gives warranty on automobiles. You also purchase 900 euros service type warranty for years or 36,000 miles. So Hamlin incurs warranty costs related to the assurance type warranty of 500 euros in 2019 and 200 euros in 2020. Hamlin records revenue on the service type warranty on a straight line basis. So what entries should you make in 2019 and 2022 for Hamlin? First, to record the sale of automobile on 2nd of January 2019. So first thing is, yes, you got a cash, you got 30,000 plus 900 euros. That was the additional purchase cost of the warranty. And then warranty, unearned warranty revenue, because this 900 that you have collected, the company collected from the customer, will not be earned as of yet until the warranty period has expired. That is 3 years. That means 900 divided by 3, for each year 200 would be the warranty revenue. And then service revenue 30,000, sorry, sales revenue 30,000. Right, so how would you record the warranty cost in 2019? That is the first year. So you would say warranty expenses, that was the actual warranty expense that was incurred in cash, 500,000. And at the end of the year, you will also pass an adjusting entry for warranty expenses 200. How did you get this 200? 900 divided by 2, that is your warranty expenses, and warranty liability 200. So what does that mean? It means on the balance sheet you will have a warranty liability of 200, that was 700 minus 500, and the income statement is going to report a revenue of 30,000 for the sales and a warranty expense of 700 euros for the warranty expenses. Right, so let's go on to record recognition of warranty liability in 2022, that is the third year. In that case, of course, unearned warranty liability, that is 900 divided by 3, because each year it is 300, and warranty revenue 300. So warranty cost under the service type warranty will be expensed and incurred from 2022 to 2024. Fine, so we'll go to the next item, consideration payable. Now, consideration payable, sometimes the company can make payments, maybe provide consideration to their customer as a part of the revenue arrangements. In that case, maybe the company can give some premiums, offers, rebates, or sometimes it can, also give some additional benefits to the customers for giving them the sales. Companies should charge the cost of premiums and coupons to the expenses for the period of the sale that it benefits from. So let's explain that with an example. Let's say Fluffy Cake Mix Limited sells boxes of cake mix at £3 per box. In addition, they also offer its customer a large durable mixing bowl. So they also give them a free gift, a large durable mixing bowl in exchange of €1 and 10 box tops. So that means the customer has to return 10 box tops plus one pounds, and they will get a mixing bowl. The cost of the mixing for fluffy cake is 2 pounds, and the company estimates that the customer will redeem 60% of the box tops which they were sold, and the premium offer began in June 2019. During 2019, Fluffy Cake Mix purchased 20,000 mixing bowls at 2 pounds and sold 300,000 boxes of cake mix for 3 pounds. Okay, so how did they do that? They just looked at this one. They said that 300,000 boxes are being sold, so they're estimating that 60% of the customers are going to bring back their boxes. So divided by 60% would be 120 divided by 10. So this is what they're thinking of, getting back. So they actually had redeemed. They sold the boxes for €3 per box, and they redeemed 60,000 box tops. So let's have a look at what entries you're going to pass for 2019. So in 2019, you record the purchase of 20,000 mixing bowl for 2. So the premium inventory 40,000, that is 20,000 into 2, and cash 40,000 for the cash that you've paid for buying those gift items. Secondly, you will also record the sale of cake mix for 2019. So cash for 300,000 boxes sold at 3 is 900,000. Sales revenue is 900,000. Next, you will also record the redemption of the actual redemption of 60,000 top boxes. So you note that for every 10 top box top, you will be taking plus a receipt of one pound. You will be giving them a mixing bowl, isn't it? So this is how you will record it. You're going to say the cash that you will receive is 60,000 divided by 10, because you will receive $1 each for the number of boxes that you redeemed, right? So you say 10, every 10 box tops will give you €1 also in benefit. So you're going to say 60,000 divided by 10, that is 6,000, into 1 is 6,000, that is the cash you received, and the expenses that you have to bear is $6,000 and the inventory that you will pay off is $2 each. So that would be 12,000 will be the value of your inventory that has gone off. Okay, so you received 1,000 in cash. Expenses that you bear will be the remaining 1,000, because $2 is the value of the bowl that you're giving to your customer. So that would be the value of your inventory. So let's see how that was calculated. So you could take it like this. You could say 300,000 was this number of boxes that was sold, and 60% of that is 180,000 they think is going to come back. Of that, divided by 10 into 1 would be 18,000 should be the cost of the redemption. Of that, you have only got a redemption of 6,000, as you saw in the previous slide. So 12,000 euros more you are expected to spend in the coming year, because only 6 months have passed and maybe 6 more months for the next year. So you have to pass an adjusting entry on 31st of December 2019 to adjust for the premium expenses and the estimated premium liability. So premium expenses 12,000 and premium liability 12,000. So what happens at the end of the year? You will find that you have an inventory of the bowls of 28,000 euro. How did you get that? 40,000 euros minus the 12,000 euros as the current, and you have a premium liability of 12,000 as you saw from this entry. Also, you will see that in the income statement, you will have 18,000 pounds as the income, that is 6,000 pounds that you received plus 12,000 pounds. So this is the revenue that you're going to, this is the premium expenses that you're going to show in your income statement. We'll come to the next item, environmental provisions. A company must recognize an environmental liability when it has an existing legal obligation associated with the retirement of the long-lived asset, especially when they can, estimate the amount of the liability. So what are those obligating events? So let's take some example. Let's say you already have some litigation under which the government or maybe the third party requires you to do something in order to set right the damages that you have done. So this could be something like decommissioning the nuclear facility. Maybe your company is dealing with some nuclear facility, and when you stop your operation, you are required to decommission the nuclear facility by spending huge amount of money, or dismantling, restoring, reclaiming of any oil and gas properties. Also possible that you may also end up in spending huge amount of money for removing the mining facilities, reclamation, or even the closures, maybe even closure and post closure of the landfills. So basically anything that requires you to make a spending in the future, such that these expenses may fall under the category of your I mean, you're managing the damages that you have done to the environment. In that case, you need to be able to measure the estimated cost and then do the entries. Okay, so company initially measures an environmental liability at the best estimate of its future cost. It needs to recognize and allocate. To record an environmental liability, the company has to know what is the cost associated with the environmental liability that it can spend in the future for a long-lived asset. And secondly, it has to record the liability for the same amount. So let's explain that with an example. Let's say on January 1, 2019, Wildcat Oil Company erected an oil platform in the Gulf of Mexico. Wildcat is legally required to dismantle and remove the platform at the end of its useful life, that is 5 years. Wildcat estimates that dismantling and removal cost will be $1 million based on 10% discount rate. The fair value of the environmental liability is estimated to be this much. Okay, so this is actually calculated based on the present value technique. So they say that $1 million at the end of the 5 year is equal to $620,920,000 today. Okay, so with that, today the company is going to record as liability the drilling platform, which is an asset for them, and the cost is 629.20 as the calculation shows, and environmental liability 629.20. So basically what you're doing is, on the date when you know that there is going to be a liability, you're actually creating a asset called as drilling platform. This is what you had created at the beginning of the project, and at the end of the project you are supposed to remove that, and the value of removal is given so and so. Okay, so that will be the entry that you would pass. So what would happen during the life of the asset? So they said the life of the asset is 5 years: 2019, 20, 21, 22, and 23. So in that case, you could use your straight line method and depreciate your asset accordingly. So every year you will pass this entry: depreciation and accumulated depreciation on the plant asset. So this you would do for each of the year where you're using that asset, so that at the end of the life, the book value of your asset would be zero, and your your environmental liability remains at the same amount. So let's look at this one. In addition, what would happen? You would also say interest expenses. Normally, because you have discounted it at 10%, every year you will add it to the warranty liability, a 10% charge on the uh, liability, and create it as an expense. So that would be also calculated as an expense. Now, what would happen in the year 2024? That is when you are supposed to dismantle the platform. Let's say on that date, the contract price was 995,000. That means on the date of the dismantle, at the end of the 5 years, you need to understand here that at the end of the 5 years, both your asset account, that is your drilling platform account, has become zero because of the accumulated depreciation, and your environmental liability account has also become zero because you have already every year you have considered 10% of this amount as your interest expenses. So both the account is reaching towards settlement, but they're saying that now on the date of dismantling, the cost of dismantle is 995. If you remember, the warranty liability was actually meant to be $1 million, isn't it? So now you only have to pay 995. That means you're making a gain of $5,000, which you could recognize in this way. You could say environmental liability will be debited $1 million, and gain on settlement would be 5,000, where the cash that you pay is 995,000. So this is how you will be passing an entry for environmental provisions. Next example is onerous contract provision. This can be some unavoidable cost of meeting obligations. Sometimes maybe the benefit was more than the received benefit. So you may want to close off this type of contract by adjusting the losses. The expected cost must reflect the least net cost of the existing contract, or whichever is lower, of either the cost of fulfilling the contract or the compensation or the penalties that you need to pay to fulfill the contract. So let's have a look at that with an example. Let's say Sumat Sport operates profitably in a factory that it has leased and on which it pays a monthly rental. Sumart decides to relocate its operation to another facility. However, the lease on the old facility continues for the next 3 years. Unfortunately, Sumart cannot cancel the lease nor will it be able to sublet the factory to another party. What it means is that the company has to satisfy this onerous contract. It's a one-time contract of $200,000. In that case, they will pass this entry. Loss on the lease contract, 200,000 because they are not using the facility, but they still are paying the lease, right? And the lease contract liability, 200,000. Let's say the same facts, but only difference is that the company has to fulfill the contract of 200, but they can they can cancel the lease by paying a penalty of 175,000. Now that, can you see, they have an option. They can choose between the two, either to pay this 200,000 to the lease or cancel the contract by paying 175,000. Of course, the company will choose the second, and anyway they should also recognize the liability and pass the entry. Loss on the lease contract 175,000 and the lease contract liability 175,000. Okay, so next we'll go to restructuring provisions. Now, what is restructuring? It's sometimes the company decides to make some material change either to the management or let's say the business as a whole. Sometimes maybe the scope of the business undertaken by the company can change, or the manner in which the business is conducted can change. In that case, the company has to prepare a detailed plan for the restructuring. They have raised valid expectation by implementing the announcement of the plan. Now, normally the restructuring can be maybe by issuing more shares, or maybe issuing more bonds. Sometimes they can even pay off their bonds before the time. There could be so many changes that the company could do. Depending accordingly, they could make those changes. So here let's have a look at that. Here we could understand what is the rules of the IFRS for restructuring. So when a company is announcing its restructuring, IFRS gives a specific guidance related to certain costs and losses that should be excluded from the restructuring. So this slide is talking about which cost can be excluded. Okay, so here we have two columns. In this column, what costs need to be included under restructuring, that is as direct or incremental cost, and the costs that need to be excluded. We'll have to pay attention to this, but very quickly I'll explain the costs that can be included. If you have some employee termination cost, maybe because of restructuring, any contract termination cost, or any onerous contract provision. Again, let me repeat, onerous means once in a while, it just happens one time. It's not a repetitive contract. Okay, so in those cases, if any such things are incurred, then they can be added to the cost of restructuring and create provisions for such. However, if because of the restructuring you end up making some new investment in some new systems, or maybe you make a lowering the utilization of your facilities, or you are spending some cost on training your staff, or moving assets, cost of moving assets or operations, administration and marketing, allocation of corporate overhead, or any expected future operating cost that is expected to lead into operating losses, unless it is one time. Okay, any one time you can include, but if it is not one time, you cannot include them as cost of restructuring, or you cannot create a provision for them. So IFRS is very clear that these items cannot run into restructuring provisions. Fine, so I'll move on with some examples. So let's say on December 12, 2019, Rhodia Group decided to close down a division making solar panels. On December 2019, a detailed plan for closing down the division was finalized. Letters were sent to the customers warning them to seek an alternative source of supply, and termination notices were sent to the staff of the division. Rhodia estimates that it is probable that it will have 500,000 restructuring cost. Now, should Rhodia report restructuring liability if it has a cost related to the restructuring? So now the question is, the solution is that the past obligation event for Rhodia is communication of the decision to the customers and its employees, which gives rise to the constructive obligation because it creates valid expectation the division will be closed. So yes, any spending that they make on sending letters to the customer or asking them to seek alternatives and so on can be added. Any outflow of resources in the settlement because of which is probable and you can reliably estimate it, can be also added to the provision. So you can recognize a provision and the best estimated of closing the division. In this case, they have already said that all this cost is going to come to 500,000. So yes, you can treat it as a provision, a restructuring provision, and show it as a provision in your balance sheet. Okay, then there are some other items like some company call them as self-insurance, but self-insurance is actually not insurance, but rather the company would talk about their own risk assumption. So there is there is no theoretical justification for establishment of a liability which is based on hypothetical charges to the insurance expense. So no such item can be allowed. The conditions for accrual states that IFRS is not satisfied prior to the occurrence of the event. Next is disclosure related to provision. A company must provide a reconciliation of its belonging to the ending balance for each major class of the provision, identifying what caused the change during the period. So in addition, the provision must be described and expected timing of the outflow must also be disclosed. So when we say disclosed, it means that you can show it as a note to the financial statement. Disclosure about uncertainties related to the expected outflow as well as expected reimbursement must also be provided. Okay, so next thing is we talk about contingent liabilities. Though when I was talking about provision, I was telling you that it may be contingent liabilities. Right now, here when we differentiate between provisions and contingent liabilities, provisions are most probably something that you need to spend for in the future, and you make arrangement for that in the current period. While contingent liabilities are those liabilities which may or may not happen. So contingent liabilities are not recognized in the financial statement because they may be a possible obligation, but it's not yet confirmed, or it can be a present obligation which is not probable. I mean, the possibility of not happening is more than the possibility of it happening. And thirdly, it's possible that you cannot actually estimate. Now, again, I would like to remind you that these three conditions are the same conditions that we were discussing about provision. If these three conditions are satisfied, that means it is a confirmed obligation, the probability is there, and you can reasonably estimate it, then you call it as a provision. But if these three conditions are not fulfilled, then they become contingent liabilities. So what about contingent liabilities? So normally the for the contingent liability, again you can decide on these basis. You could say that if you think that the outcome is virtually certain, possible, that is at least 90% possibility, probability is there, in that case instead of, you can treat them as a provision. Remember, we talked about this in the previous slide. Similarly, if it is more likely than not, that means if the probability is falling from 51% to 89%, still you can report it as a liability. Remember, again, you have to fulfill the other conditions. However, if it is more possible but probably not, and if it is remotely possible, that means if the probability is 5 to 50% or even less than 5%, then I mean, again, they have classified them as two. If the probability is from 5% to 50%, in that case, you don't have to report it as a liability or a provision. Rather, you need to disclose it as a note to the financial statement. And if the probability is less than 5%, there is no need for any disclosure at all. You don't need to consider it either in the financial statement or as a note to the financial. So again, we'll talk about a small topic. This is called contingent asset. What is contingent asset? It is just the opposite of contingent liability. Remember, contingent liability, if an item cannot go as a cannot be reported as a provision, then you can consider it as a contingent liability. It could either become a liability or it could be a provision depending on the conditions that we saw earlier. Now, what is contingent asset? It's just the opposite. The possibility that you could get some benefit in the future, right? So what does that mean? Let's read this out for you. A contingent asset is a possible asset that arises from a past event which whose existence will be confirmed by occurrence or non-occurrence of certain uncertain future events not wholly within the control of the company. They can be typical contingent assets if the possible receipts may be money from gifts, donations, bonuses, or maybe possible refund from the government in time in a tax dispute, or it could even be a favorable outcome from a court case which is pending. Now, this is just the opposite of what we were discussing under provisions and current contingent liability. However, you have to note that contingent liabilities cannot be recognized. You can never take a contingent asset on a financial statement. So, what is the general rule again? For a contingent asset, if it is 100% certain, I mean almost 100%, that means more than 90% certain that it will happen, in that case you don't have any contingency, but rather you have to report it as an asset. If the probability is 51 to 90%, in that case you can disclose it in the notes, but anything other than that, you don't have to disclose it. Remember one thing, there is no such thing as contingent asset, and you cannot show a contingent asset in your financial statement. What you can do is either treat it as an asset, report it as an asset if the probability is almost certain, or you can disclose it in the notes to the financial statement. So contingent assets are disclosed when the inflow of the economic benefit is more than 50% likely to happen. All right. So finally, we come to the end of the chapter. Very quickly, I'll go through the presentation of the current liability. We know that current liability will be reported at their full maturity value. The difference between the present value and the maturity value is not considered because current assets are going, current liabilities are going to expire within a year. You don't have to consider the present value. Okay, this is how a balance sheet will look like, and this is your current liability part of your balance sheet where the various items could be presented. Okay, next is you could also make some analysis. I think this is not a matter of a discussion in our chapter here. Anyways, you could calculate the current ratios and the acid test ratios by using the items current liabilities that we have discussed in this chapter. Okay, so in this example from the previous uh, Wilmar International Company's statement, current ratio is current assets by current liability, and acid test ratio or the quick ratio is cash, short-term investment, receivables by current liability, which could be used for your analysis of the company's liquidity position. With that, let's end this chapter. I hope you found it useful and interesting. Please let me know if you have any questions. Wish you the best and enjoy life. Take care.